Good afternoon, friends. I'm Sandeep Biyani, heading business development and sales for Alpha Credit Advisors. Welcome to Alpha Credit Advisors AAA Investors Connect. In our last, in fact, in Jan 23's investors outreach, we had pointed out that 2023 will be the year of India. With our presentation, if you remember, zoom in on India. And exactly after 6 months, on 30th June of 2023, Nifty index touched new high of 19,000. This is certainly a reason to celebrate. While global macros are gloomy, India has become a shining star. Mid-cap and small-cap indices have also been booming. While there is a positivity all around, we all have questions like, is this rally sustainable? Are the valuations too high? How should we place our portfolios for maximum returns? To understand many such questions, we at Alpha Credit Advisors take a hard look at the reasons for the rally, as well as and how things could shape in our coming future. In fact, I call upon our founder and managing director, Mr. Rajesh Kothari, to take us through the presentation and enlighten us with his thoughts on this. Welcome, Rajesh.
Thank you, Sandeep. Thank you very much. Good afternoon, friends.
Yeah, in fact, Rajesh, I would like to request you to start with some brief, some light on our investment philosophy, and then can take on the presentation. Over to you, Rajesh. Thank you.
Great. Thank you. Thank you, Sandeep. Good afternoon, friends. A warm welcome to all of you for this AAA Insights Winner Series webinar. And I think Sandeep has already get the ball rolling on in terms of what is actually right now going in the minds of investors. Are we too high? Are we expensive? Can market go up further? Should I do lump sum? Should I do staggered? I think these are the typical questions what even we get during our interactions with investors. Before I get into market, in the interest of many participants who might be probably joined for the first time, let me also talk a little bit, maybe about 3, 4, 5 minutes about our investment philosophy, a little bit about Alpha Credit Advisors, and then we probably proceed to the presentation. So friends, as all of you are aware, our investment philosophy is quite simple philosophy. Protect capital, create wealth. To protect capital, we strongly believe in diversification. We are pioneer of 50 stocks portfolio in Indian PMS industry. And it is with that 50 stocks, we have delivered about 18.5% compounded annualized returns. So 1 crore has become like 9 crore in 13 years, compared to benchmark returns of 11 to 12%. And with such low risk, with the low beta and high alpha, again, we received the award as the best #1 multi-cap PMS and #2 on overall across PMS ranking by PMS AIF World methodology by IIM Ahmedabad. Let me a little bit again get into what we do to protect capital is, of course, one is the risk management. And for that, as I say, diversification is one very important thing, to reduce the risk. And second, very important is, very important is, having a very strong discipline, exit strategy. And with that, let me also share with you my screen. Please bear with me for one moment. I'm just, opening up my presentation. Give me one moment, please. Just a minute. Please bear with me one moment. It is still opening up. Is my screen is visible?
No, was not it. Yeah.
Why is nothing is showing?
Now it's taking time.
Yeah, but I think is there any issue? Oh yeah. Maybe some issues in network or what? Is it slow a little bit?
It's slow.
Give me one moment, please. Sorry,
Yeah.
sorry for this technology snack, but so to protect capital, I was saying that we believe in diversification, and second, of course, very important thing is not only focusing on what to buy, but equally focusing on when to exit. So discipline exit strategy is something very important. In terms of stock selection, we have a very unique approach, 3M approach: market size, market share, and margin of safety. Buy the businesses where size of opportunity is huge. Buy the businesses provided they are the market leaders, they are industry leaders, and buy the businesses at a reasonable valuation, something which is very, very important. The quality, how we do the filtration of quality, there are total 5,000 listed companies in India. For these 5,000, we get down to about 800 companies where the profit size is more than 50 crores, about 600 companies where profit size is more than 100 crores. From this, to reduce the risk, we avoid the companies which have a high leverage or very poor cash flow conversion. So that leads to about another 300 companies which get into that bucket. And from 300 company, we make the alpha producer, which is a 40 to 60 companies portfolio. Of course, we have a detailed forensic assessment, we have a detailed longevity assessment, and after that internal checks and balances, we create portfolio. And as I said, exit strategy, we implement exit, one, to rebalance in our portfolio weightages. So if 3% becomes 5%, we again reduce to 3%. Second, we exit when company doesn't meet our buy and hold criteria. When, for example, something seriously goes wrong with the management or with the governance. Third, we sell the company when company target valuations are fully reached. Like, for example, last year, IT stocks, most mid-cap company stocks were trading at 50, 55 PE, which is equivalent to like Unilever India kind of a valuation. And we said there is no further upside from here. So we reduce the IT sector weightage. Fourth is we don't expect company to do great returns. And last, when there is a compelling better opportunity. So this is the reasons how we implement our exit strategy. Just one important slide I wanted to repeat, which actually I also displayed during my last webinar, that there is something called volatility. And this volatility is increasing every day in the business cycles. And I would like to break the common myth that there are sectors which are defensive sectors which generates consistent profit growth every year. That's a myth. And I would like to show you that slide that even the consumer sector or the pharma sectors, so-called defensive sectors, they have underperformed the India GDP growth 40 and 60% of time in last 10 years. So like, for example, consumer reported subdued number of 8% in FY14, 9% in FY16, 5% in FY18, and -3% in FY21. Or for that matter, pharma, -6, 7, -11, 6, and 8. So any number which is below 12% to us is basically suboptimal number, is actually poor performance, and therefore even 40% of the time consumer sector underperform India GDP growth. So there is nothing called consistency about any sector when it comes to the earnings growth. And because of such volatility in business cycles, the index performance also going up and down, irrespective of which sector it is. So even the defensive sector, be it consumer or be it healthcare, even those sectors, they go up disproportionately and also come down disproportionately because of the changes in business cycle. With that, let me now directly come to the heart of today's discussion, the market outlook. Friends, One very important thing which India is right now experiencing is the number of companies which are increasingly becoming bigger and better. If you look at globally, any emerging market, whenever company reaches $500 million benchmark revenue, that becomes sizable. And that results into the virtuous cycle of revenue creating the scale, scale creating the competitiveness, competitiveness results into the better cost results into the better market share, and better market share results into better efficiency, and better efficiency, there's a virtuous cycle. And that creates employment for the country, and it creates the consumerism in the country. Let's look at in last 5 years what has happened. In last 5 years, companies with more than 5,000 crore revenue, they've increased by 38%. That's huge. Remember, last 5 years were not great years for the world economy. Of course, pandemic years, there were 2 pandemic years and 1 Russia-Ukraine war year. And despite those 3 years challenges, number of companies which increased revenue to more than 5,000 crores, that number increased by 38%. If you look at the number of companies where the profit has increased, benchmark 500 crores, and that's really become a mega companies, those companies registered 58% increase. That's a huge number. And as that number is becoming bigger, as I say, the competitiveness results into significant increase in competitiveness. Let's look at, for example, IT services. In FY 2004, our market share in the world IT services was just 2%. And today it is 16%. IT exports went up by 8 times in last 22 years. And as a result of that, the market share also went up from 2% to 16%. So today we are roughly about a $99 billion IT exports. If you look at the pharma, same thing happened in pharma in last 3, 4, 5, 9, 10, 12 years. The number of companies which reported the overall export growth, that is huge. And same thing is now going to happen in emerging sectors like electronics and specialty chemical. If you look at the electronics in particular, the government expectation is just in next 3 years, exports will touch $77 billion. Currently, we are roughly at about $18 billion. So 18 to $77 billion in a matter of just 3 years. If you look at the specialty chemical, that will also become roughly $77 billion. Now think of it, IT took almost 20-25 years to reach to $99 billion. And same kind of a pace, significantly higher pace, we are going to see under the electronics sector. In fact, April, May, June electronic exports number, they are so great that probably they have even outpaced the pharma exports for the first time. Now, that is a huge significance for this, because when country creates such new avenues of growth, it adds wheels to the vehicle. There is always a surprise to many investors that historically, whenever the world markets enter into a recession, they sneeze, we used to get fever. This was the first time in last 75 years. Then the world market is under fear. But India is resilient. Because not that our exports were not get impacted. Our IT export also got impacted. Our textile exports also got impacted. But we added the new avenues of growth for the economy. And as that happens, the resilience of Indian economy has improved significantly. And that's something very, very remarkable thing India has achieved in last 5 years. And because of such significance of adding the new wheels to the growth, the corporate earnings growth is also going to improve compared to what we have seen in last 11 years. Sandeep has asked in the opening remark, the perception in normal investors that markets are at all-time high. Are we at all-time high at a price perspective? Answer is yes. Are we at all-time high from the growth perspective compared to our own history? Answer is no. And what is market? Market is nothing but mirror of earnings growth. Look at 2003 to 2008. Earnings grew by 26% and Sensex became 5 times in 5 years. And then came a harsh winter of almost 12 years where EPS growth was below 10% and Nifty also gave only 12%. The question what we need to understand and ask ourselves, can India earnings grow by 12, 13, 14% for next 3, 4, 5 years? The strategic building blocks are in place. For the first time, the macro environment is in our favor. The inflation is cooling down. I'm sure many of you attended our last 2 webinars and we said that the worst of inflation is behind us. We said the worst of interest rate is behind us. We said worst of supply chain pressure is behind us. And today, if you look at it, whatever all we talked about as that this will be the future headlines of Times of India is actually coming true. And as that happens, fortunately, it is coming at a time when the bankers' balance sheets are in a great healthy shape. It is coming at a time when the bankers' balance sheet, they are willing to lend. It is coming at a time when the corporate India, the borrower, is also in a best of the health. In fact, corporate India repaid 1,70,000 crores during COVID period. They reduced their debt. So borrower is willing to borrow, lender is willing to lend. And this is coming at a time when geopolitically India is rightly positioned. They are taking benefit of China plus one. We are taking benefit of Europe plus one. And this is coming at a time when the government of India is taking its best efforts to accelerate the formalization of the economy. And this is coming at a time when the digital infrastructure put up by government, it ensures that not only we grow at a higher rate, but the growth becomes more productive growth. China also grew during the China decade, but they put up even 100-kilometer bridge, probably where it was not required. Whereas India is conscious. We are absolutely conscious that what kind of growth we are buying into. And we are buying into high quality growth. And therefore, what is important for investor to ask is, can India deliver 12, 15, 17% earnings growth over next 3, 5, 7 years? And if you ask my personal view, I think that the building blocks are in place. Strategically, we are at right time, at right place to accelerate the growth from 10% Nifty growth to 12 to 14 to 15% corporate earnings growth. In fact, this is third year where India is going to see double-digit earnings growth. In FY21, we have seen double-digit growth, but that was because of poor base of FY20 because of COVID year. So I take out FY21 from my calculations. But if you look at FY22, corporate India delivered double-digit growth. If you look at FY23, corporate India delivered double-digit growth. If we look at FY24, we are likely to do 11 to 13% Nifty earnings growth, again double-digit growth. And therefore, this is something very important. Again, I am re-emphasizing that the earnings growth cycle we are entering into from single-digit earnings growth to double-digit earnings growth for a longer tenure. It is not for 1 year. It is not for 2 years. This is going to happen for the third year and probably even the next year. And as that happens, the valuations which people always ask us, that what is your view on valuations? We believe there is an upside risk to the valuation rather than downside risk to the valuation. Why we think so? Because if you look at last 10 years, the average valuations are roughly 20 times. And today, we are actually below 20 times on FY25 basis. And we are at 19.8 times on FY24 basis. And last 10 years is 20.2. So we are not expensive. We are probably not cheap as well, but we are not expensive. We are fairly valued on 1 year forward basis. As the growth gets sustained, the double-digit growth comes into the system, the PE normally expands during such high growth environment. When the return on equity of Nifty is improving, normally you see the PE expansion in such efficiently improving ROE trends. When the corporate India deleverage balance sheet is gaining strength, normally it becomes a cause for the expansion into the PE multiples. Cutting the long story short, one, the worst of inflation, interest rate, and supply chain is behind us. Number two, India is adding more wheels to its vehicle by adding the number of new sectors like electronics, like specialty chemicals for the exports and for the domestic market. Number three, corporate India balance sheet. The banking balance sheet is one of the most healthiest balance sheet currently with a low credit cost and high non-food credit growth. Number four, the government is making all its efforts to improve the capacity utilization. The capex revival has already started. And last but not least, the earnings growth of corporate India is going to be double-digit growth, 11 to 14, 15% compared to 9% growth we have seen in last 10 years. And number six, the last but not least, the valuations, we are at 10-year average valuations. And that makes us to conclude that we remain bullish on India with a 3 to 5 years view. We believe that earnings growth trajectory is going to remain strong. We believe that valuations will sustain at current levels, and probably there is an upside risk to that valuation number, considering that ROE is improving and the growth trajectory is also improving. So that's basically our view on Indian equity market. I already talked about the valuation. October 2021, Nifty was 19,000, and today also we are at 19,000. So actually, if you look at it, during this period, the EPS growth is 20% and time correction of 10%. So you are getting market at 30% discounts compared to what it used to trade. So market is actually not 19,000, market is around 16,000 or so, but on a price basis, you feel that market is at all-time high. The valuations are not at all-time high, correct? It is like saying, so there are many investors, they buy the stocks when the stock goes down 40%. And I always tell them, that's not the right way to look at it. Valuation should go down 40%. If the stock price corrects, but EPS also corrects, then you are not getting the stock cheap. And likewise on the upside. So we believe that market valuations have corrected, but the earnings growth is actually improving. What are the sectors what we like? On 1st April, we wrote a big newsletter, AAA Insights, and we said that there are 3 C's what we like. The first C is capital goods. This is a sector on which we have been extremely bullish from last 2.5, 3 years. And currently we are 14% of the portfolio in AAA IOP is capital goods. About 25% of the portfolio in AAA budding beast is capital goods. Why we like this theme? Because we believe that the moderate to high inflation is a good thing for capex to improve. The leverage is reduced, credit growth is improving, capacity utilization is improving, and therefore that will lead to the capex cycle revival. In fact, in our capital goods presentation, what we did about 1 year back, whatever we talked about in terms of the growth drivers are now fructifying. Our portfolio of universe of companies which we track for capital goods, they have reported 41% growth in order intake for FY23. This is the second highest in last 13 years. What does it imply? Capital goods company, they receive the orders. When those order book grows, it means the customers of such capital goods company, they are thinking to expand their capacities and therefore they have ordered for the machinery. It means they are seeing the better demand environment for their end customer. It means the economy is going to do much better because capital goods is a leading indicator of Indian economy. The second C is corporate credit, overall credit growth. We are very positive on this overall banking space. We believe that credit cost, the worst of credit cost is behind us, and the credit cost for banking sector is actually reduced. from almost 4% to less than 1% in FY23. So this is the second space, what we like. Within banking and finance, we prefer what I would say, we believe that NBFC, which probably got impacted significantly in FY23, they will get now benefit in FY24. So within banking and finance, we are moving a little bit, away from banking and a little bit for NBFC. So, that's basically within banking and finance, how we look at it. So basically that's about the, sectors. And now let me quickly take you through both of our PMS plans and AIF in terms of how we are positioned. So this is Triple India Opportunity PMS. As all of you are aware, this is a multi-cap PMS with 13 plus years of track record. This plan is delivered 18.5% compounded annualized returns. It is a 50 stocks portfolio between large cap, mid cap, and small cap. These are the sectors on which currently we are allocated. Banking is roughly 29%, consumer is 19%, engineering is 14%. We remain positive on auto and auto ancillaries, roughly about 11%. We remain underweight on IT and pharma, although we are selectively looking at opportunities. So this is 7 and 5% weightage, and so on and so forth. How was our FY23 in terms of earnings growth for our portfolio companies? That's something very, very important. Friends, I'm very pleased to share with you that Triple India Opportunity PMS earnings growth remained extremely robust for FY23 at 35% compared to Nifty earnings growth of only 11%. And we expect our portfolio companies to continue to deliver 24% growth and 22% growth for FY24 and FY25 respectively. One slide, which is always my favorite slide, walking the talk, quantifying the quality. As you are aware, this is a multi-cap product. Roughly 55% is large cap and roughly 48% is into mid cap and small cap. However, we do not buy any small company by profit size. I said in my opening remarks that there are about 600 companies in India, only 600 companies in India, which makes 100 crores of net profit after tax. Most of our portfolio companies, irrespective of their market cap, they all are large companies by profit size. So 99% of the portfolio companies have 100 crores plus profit. So they might be classified as a mid and small cap because of the regulatory definition. They are not into top 100 by market cap, but when you look at the profit size, they are actually top best of the companies in the listed space when it comes to the size of the profit. How is their balance sheet? Almost all companies have either zero debt or they have a debt equity less than 1 time. Now, this is a very, very rare combination. On one hand, our portfolio companies make sizable profits, 500,000, 2,000 crores. On the other hand, there is zero borrowings, zero overdraft facility. They don't take any overdraft facility from the banking. How this is possible? This is possible because they are true market leaders with the right to win in their respective categories. And that market leadership results into the high return on net worth and that they reinvest into their business, resulting into high earnings growth compared to the Nifty indices. Before I talk about the compounding returns, this slide is something very important. How this PMS has performed during the downtime of the market. Friends, 14 out of 16 periods, whenever market had declined, AAA IOP PMS has outperformed the benchmark indices with a median returns of 2.5%. Protect capital is something very, very important. Our drawdown, the decline was less than benchmark, despite we are 50% into mid cap and small cap. That resilient performance is driven by right stock selection, be quality conscious, and at the same time be agile to make sure we have a very strong disciplined exit strategy. To show you how agile we have been in last 3 years, I'm showing you one slide where, like automobile, we became bullish on this sector post on lockdown, and we kept increasing from 5% right now, it is 11% weightage. And look at the BSE Auto Index performance. The index is up almost 52%. Likewise, in banking, we became bullish post on lockdown, 24%, increase the weightage slowly, about 29%, and index is up roughly 32%. If you look at the engineering, we have been bullish on this name from quite some time, and this index is at all-time high, with index gaining 30 plus 48, almost 79% in last 2 years, 3 months. IT sector, we increased the weightage during COVID, and then we reduced the weightage 15 months back because we could foresee that US is entering into slowdown, and that will result into slowdown in IT companies' earnings, and therefore we decided to reduce our portfolio holding in the IT name. So 13% we reduced to 7%, index is down almost 18%. The reason why we sold IT, like we've been holding about 3%, we increased the weightage to 9, we further increased to 13, and then we reduced to 7%. Why we sold IT stocks? Because the valuations pre-COVID was 18.8 times. And when we sold, they all became 35 times. And the tier 2 valuation increased from 19 times to 65 times. Everybody thought this company will keep growing at 30-40%. But everybody forgot that pre-COVID for 9 years, IT company grew only by 11-12%. From 12%, the growth became 25 to 30% during COVID time. But you can't extrapolate that number. And to that extrapolated number, market started giving them FMCG companies valuation. In fact, we started getting the research report. Can IT company trade at a FMCG valuation? And that was actually the, we said this is basically the best time to get out from the IT stocks. And we reduced our weightage from 13% to 7%. What I'm trying to highlight you is that, of course, you need to be extremely conscious about what are you buying into, but that is not sufficient to make money. You also need to be, what I would say, take due care of when you should exit. You need to make the prudent decision of exiting from the businesses. And there are so many examples in your portfolio. I'm sure many of your clients or many of our investors who are right now on this call, you would have experienced, like we sold Sundaram Fastener, we bought it during COVID, we made 140% returns, and we get out of it. Or Britannia we sold after holding for 7 years. Or Dixon is a classic example, almost it became 5 times from our purchase price, and we exited exactly about December 2022. Or for that matter, Divi's, we bought Divi's, and then in July 2022, Divi's reported bumper numbers. It is a great number, but good part of that number was from pandemic-related drug called Molnupiravir, which they supplied to Merck. And everybody thought that this growth will continue at 30%. But the world was on lockdown. And that was May, June, July 2022. And we decided to take the exit because earnings growth, we said, will not continue at this pace. And of course, valuations were 45 times. Or for that matter, Metropolis, we bought during COVID time. We almost doubled our money and we sold in about 16 months from our purchase in October 2021. So what I'm again trying to reflect is that we buy the best of the businesses, supported by best of the financials, best of the governance. We identified 40 to 50 sectors where there are market leadership. We select from it. We make sure they have earnings growth. And on top of it, we make sure we have agility with a disciplined exit process. And that results into these 18.3% compounding returns compared to benchmark returns of 12.1%. And these are 1 year, 2 year, 3 year, 5 years, and 10 years since inception performance. Mind you, in last 2 years, while the performance looks at par with benchmark, please remember, we do not invest into oil, metal, and Adani group companies. And because of that, these three contributed actually almost 25% of total Nifty gain. 25% of the total Nifty gain came from these 3 buckets. And we don't invest into it due to our own internal risk management practices. And we are absolutely fine with that because we would like to protect capital and create wealth. Despite not having it, we did reasonably well compared to the different various benchmark indices. This is a performance year-wise. Of course, if anybody is interested, we can always send you the full presentation. It is there on our website. Importantly, we always believe in delivering superior risk-adjusted returns. If you look at the beta of our portfolio is less than 1, something very important. Standard deviation is also less than benchmark, and we have very high rolling returns, very important for any large family office to check what are the rolling returns. Let me now briefly talk about our AAA budding beast. As you all are aware, we look at the universe from the profit perspective, 5,000 listed companies in India, but only about 600 companies make 100 crores plus profit. But according to the market cap definition, only 1 to 100 are called large cap. It means out of 550 companies, 82% companies by default goes into mid cap and small cap. And that has resulted into many sectors flowing into the mid and small cap space just because their market cap was not equal to top 100 by market cap. Like for example, Phoenix Mall, India's largest retail mall in the country, is mid cap. Or for example, 2 companies which are listed in luggage, VIP and Safari, both are small and mid cap. Or for example, entire wire and cable industry is mid and small cap. Entire plywood industry, Century Ply, Green Ply, all are mid and small cap. Entire hotel industry is mid cap. Entire staffing services, whether it's Quest Corp or Team Lease, they all are mid and small cap. Trend in 2019 was actually a mid cap, and so on and so forth. When we saw that many of our selected sectors where the competition is very, very limited, which are truly oligopolies, but because they are not top 100 by market cap, they become mid and small cap. That actually becomes our theme, that why not we carved out as a separate product from our IOP multi-cap. We have been always doing mid and small cap since last 13 years. In fact, if I do attribution of my IOP multi-cap, the mid and small cap contributed almost 23% compounding returns compared to benchmark returns of 10%. So cumulative returns is 1,000%, or almost 5x better than the benchmark BSE mid and small cap index. And that's why we carved out this as a separate product. How is the allocation here? 29% is capital goods. Banking and finance is 17.7%. Consumer is, just a minute, please. Auto ancillary is about 11%, and software and chemical is about 3.5%. Again, I would like to highlight you one important point that, say, for example, the chemical, we have been very bullish on this thesis, entire thesis, and we actually did a very presentation about 2 years back to all our investors. But when all these chemical companies valuation became ultra expensive, we sold most of these chemical companies last 6 months back and 7 months back. Again, agility is something very, very important. So we sold most of these chemical names in about 6 months back, and today most of them, these names are probably down 20, 30, 40% from our exit prices. So this is how we are allocated to budding beast. While 29% is engineering, we do not own a single company into road construction. We do not own a single company into railway construction. We do not have a single company which is into EPC and irrigation and port and all that stuff. What we own is a really high technology backed companies where R&D is a moat, the technology is a moat, and these companies have all zero borrowing, zero debt. They all are, most of them are multinationals. Say, for example, the largest diesel genset manufacturer, we own this company. For example, the largest smart grid global, we own this company. For example, the largest capital goods company, multinational, which is a subsidiary in India, we own this company. For example, the third largest German manufacturer in pump industry, we hold this company, and so on and so forth. So just like our IOP multi-cap, the budding beast owns the companies which are actually very large companies. They are big companies, but their market cap is classified as a mid cap and small cap. The average weighted market cap of this plan is roughly about 22,000 crores, giving you some sense of what kind of companies and the business size what we buy in this PMS plan. Again, this is a 50 stocks portfolio, and let me now take you through the very important, what is the underlying earnings growth of this portfolio. This portfolio is reported 48% growth in earnings in FY23, and we expect them to deliver 32% growth in FY24 and 27% growth in FY25. Very, very sound wicket. Most of our portfolio companies in capital goods, they are benefiting from China plus one. They are benefiting from Europe plus one. We own few NBFCs. They are benefiting because of the NEEM over a period of time will come in their favor. We own many consumer companies, which are natural beneficiary of acceleration of the formalization and many more such themes that we own in this portfolio. What are the characteristics of this PMS? 94% of the portfolio companies, they all are large companies, as I say, 50 crores plus, and 82% of the portfolio companies are 100 crores plus in terms of the profit size. In terms of the balance sheet, the risk mitigator, 60% of the portfolio companies have zero debt, and 35% of the portfolio companies have debt equity less than 1 time. They are true oligopolies, they are true monopolies, they are real market leaders, which gives them high ROE, 16%, and with a very strong earnings growth, 48%. To give you some perspective, and these are not recommendations, these are I'm just explaining to explain our process, that our largest holding, for example, the top 10 kind of companies, like for example, Cholamandalam. Now, really large Murugupa Group company, one of the largest NBFC with a high market share in commercial vehicle and many more such segments. Our another large holding is ABV, which is again one of the largest global company with a subsidiary in India. Our third largest probably is Tata Group company called Trend. This has been 1.75 million square feet west side and now 1.75 million square feet Zudio. So fantastic franchisee on the retail side, but it's a part of our, it was actually mid-cap when we bought that and initiated it. Probably now it has become a large cap. Our another large holding is the largest genset manufacturer company, US-based company with a subsidiary in India called Cummins. Our another large company is second largest luggage company in India called Safari. Our another large holding is the largest water purifier player called Eureka Farms. What I'm trying to convey to you is we buy businesses which are true market leaders in their respective industry with the best of the balance sheet, preferably zero debt, oligopolistic kind of a market environment structure with a limited number of players available in that industry, buy the best high growth company within that universe, make sure they have a low leverage balance sheet, make sure they have a high earnings growth. So classic way is to make sure that on one hand, we should avoid the junk trap, that momentum trap, the junk trap. And on the other hand, we would also like to avoid to fall into the quality trap because there are many high good quality companies, but they don't offer growth. So there are many companies which are market leaders, but they don't have the great balance sheet. Of course, we have to avoid it. And there are many companies, they are market leaders with great balance sheet, but they don't have good earnings growth. Again, we need to avoid that. Like for example, Myco Bosch. It's a very good company, but look at last 10 years earnings growth. It is less than 11%, and India is growing at 11% in terms of GDP growth. So great company, but not great earnings growth. We need to avoid such names. Am I right? Provided, of course, we see that future is not going to change. If we see future is changing, then we can buy into it. So what I'm trying to say is that that's how we construct the portfolio in budding based really large companies in their respective sectors with a good balance sheet, high ROE, and high earnings growth. What has been the performance of this plan? This plan is delivered 42% on 1 year basis compared to BSE 500 returns of 24, and on 2 years basis it is 24.3 compared to benchmark returns of 11.7, and since inception it delivered 29.4 compared to benchmark 16.7. How is the risk management of this plan? Beta is less than BSE 500. Despite is a budding base, despite is a more of mid and small cap names, the beta is less than benchmark. The standard deviation is less than benchmark, and Sharpe ratio is one of the highest on the street. With that, I take a pause here, and I again thank you all of you for your valuable time for this webinar. And with that, I would like to open it for question and answer session. And before I do that, let me also just talk about and thank all my investors. We launched our AAA India Equity Fund. It is a category 3 open-ended, non-lock-in period product, which we launched in about 1.5 months back, and we have received very good response. to this product. So we take this opportunity to thank all of our investors for that. It is a multi-cap product, with a 50 stocks portfolio with a 1 or 2 additional features on top of the regular portfolio what we own. There is no lock-in period, and there are very nominal exit load for the first 12 months. After 12 months, there are no exit loads. With that, now we have PMS as well as AIF. Depending upon what structure is friendly from the investor perspective, that was basically the purpose why we launched this AIF. And of course, we have a STP plans, systematic transfer plan through AAA liquid PMS. So if anybody want to do staggered approach, they can always opt for STP over 3 months, 6 months, 12 months, and then they can move to the equity as a PMS. So with that, thanks once again, everyone. Thank you for your time. And Sandeep, I request you to kindly put all questions, whatever you get, one by one from the chat box. And
Sure.
Investors, please feel free if you have any queries. Thank you.
Yeah, thanks, Rajesh. Requesting all to please post your questions in Q&A sections, and please, by the time questions come, there is one questions already there, from Mr. Jai Sitaram. While we are hearing about a lot of private capex from companies earning calls, is that visible from the private corporate credit growth as well, ex the airline orders?
Yeah, good question, sir. So yes, in fact, there is one macro number which one can track, which is called, non-food credit growth. And if you look at the non-food credit growth, we are now running at double-digit non-food credit growth. I think from August, it has started double-digit, and this is after 12 years. So yes, the non-food credit growth is reasonably strong. And to further confirm what is happening on ground is, as I said, our universe of companies in capital goods, excluding L&T and BHEL, because at times they issue the huge orders and it can skew the order book. Our portfolio companies universe have reported 41% growth in order intake in FY23, which gives you indication, not only indication, the comfort and confidence that capex in India is improving. The reason why it is improving is because one is, of course, the PLI, second is China +1, third is Europe +1, and fourth is, of course, the improvement in capacity utilization, which is happening in last 4, 5, 6 years. These are the 4, 5 reasons why the capex cycle is turning. I hope that answers his question.
Okay, thanks, Rajesh. The other questions from Anonymous Reddy. What is the view on real estate? Is it better to invest in equities than real estate? I invested 13 years back in real estate in Mumbai and equities as well, and see that the returns are almost the same.
Oh, wow, great. Good question. At least somebody said returns are same. Otherwise, most people feel that my returns in real estate are exponential. And you know why they feel? Because they buy at 3,000, say 20, 30 years back, and today it is 13,000. So they think it has gone up. But actually, when you look at compounding returns, they are actually at times very, very minimal compared to what normally industry has seen. So, I think the two asset classes are different and both have its own pros and cons. While the returns may look similar, every asset class is a cycle. At times, it might do better. At times, it might do worse. But on a longer term horizon, the equity as an asset class always outperforms the fixed deposit, gold, and real estate as an asset class. And on top of it, please keep in mind the liquidity what equity as an asset class can offer you, no other asset class can offer you, number one. And number two, the transparency. What equity asset class can offer you, nobody can offer you. See, in fact, one of my very good friend who is one of the large wealth manager in one of the premium institute, he told to his investor that let's assume if you buy a house at, say for example, 2 crores and there is a crash on real estate. It happened, in 6 years back. Everything went down. Did you thought even to sell your investment in real estate? I'm not talking about a house. I'm talking about an investment, additional house. And he said, no, I can't even think of it. So if you have the same principle in equity, that even if it goes down, you don't even think to sell, forget looking at it, you actually make much bigger money. So I think equity as an asset class will continue to deliver high returns compared to any other asset class, provided you have a long-term view and provided you have a stomach to absorb the volatility of the equity asset class.
Thanks, Rajesh. Mr. Surya Kothari is asking, what is your view on IT services sector?
Just to conclude,
okay, sorry.
Sorry, he actually put one more question that including
it includes the rent. It includes the rental income. Then the returns are same.
Oh, I have an answer to that. If you include the rental income, please also include the property tax, the maintenance bill which you have to pay to refurbish the property after 13 years, kind of capex what you need to make. Please make all this adjustment in your Excel sheet, and then you will come to know the returns are much lower than equity market. Of course, please also at the brokerage, whenever you want to renew your rental, and if your lease is going out due to COVID, you have to find the new leasee, and you have to pay 1 month brokerage. In equity, brokerage charges are probably less than 0.10. I don't know how much you pay in real estate. Typically, it is 1 month brokerage, if I'm not wrong. Please put all these numbers in actual Excel, and then please compare the returns of class A versus asset class B. Sorry, Sandeep, please go ahead.
Yeah, at the same time, I would like to add the transactional hassles. That's the most differentiating in real estate and the financial asset called like equity. Anyway, thanks, Rajesh. Moving on, the next question, question from Mr. Surya Kothari. What is your view on IT services sector? Is the worst is over?
Yeah, so basically, IT services currently we still remain underweight. We are selectively looking at IT sector in terms of bottom-up opportunity. Please understand, this sector has grew about 9, 10, 11, 12% during last 10 years. I'm talking about 2010 to 2020 pre-COVID. Now, during COVID, the growth became very high, 20-25%. And now it is back to single digit. Please understand, the India GDP growth is 11%. For anything to be exciting, the earnings growth has to be 15% plus. We believe the IT sector in general will give you 12 to 15% growth. It is not going to be 20% plus growth for next 5 years or so. But yes, within IT sector, there are some opportunities which basically we are evaluating, and where we believe the growth can be higher than the 12, 13, 14, 15%. And such IT companies will be taking the exposure to it. So in terms of the overall view, underweight today. However, depending upon when we see the mid cap or any growth opportunity, we'll surely look into it.
Thanks, Rajesh. The next question is from Mr. Neeraj. Sir, please share your views on NBFC gold finance companies. Do we cover in our universe of coverage?
Oh yes, we do cover under universe of coverage. We hold one of the largest gold finance NBFC in our portfolio as well. We are pretty positive on this name because last 3 years were not great years for gold finance NBFCs. The banking were gaining market share in the same space. But now I think that probably the competition is going to reduce within the gold finance as a segment. Number one. Number two, the NBFC which we bought, which we added, which is the largest gold finance company in India. And we also added another company, which is a third largest gold finance company in India. Both of these companies, they have got licenses to expand the branches, which is very important. And number three, we believe that the credit growth, as well as the net interest income growth, as well as the credit cost, all three are going to be under our favor. Why we bought it? So one, of course, the growth and the valuations have actually cooled down in last 3 years. And therefore, the margin of safety is in our favor. Hence, we added these names in our portfolio.
Thanks, Rajesh. The next question from Mr. Sarvanan K. Sir, it was pleasure listening to you as always. You have been one of early entrant in sectors like specialty chemicals and capital goods, and that hugely benefited the investors. Could you please tell us any new sector that you are building in your portfolio currently?
Thank you, Sarvanan. Nothing new as a sector, but yes, consumer is one space which we are liking on incremental basis. As I said, we believe the revenue growth. So that was the third C. The last year the rural demand was under pressure, which impacted the top line growth for many FMCG companies. Last year the commodity prices were going up because of the inflation. That also impacted the margins of the FMCG company. This year both are going to reverse. The government has already announced its MSP price, so agriculture income growth is going to be much better compared to last year. So rural demand is going to be better. You are already seeing the proof of this in two-wheeler volume growth, where we are already seeing the early signs of revival. On the other hand, the commodity basket, 80-85% of this commodity basket, which are raw materials for consumer companies, they are on a declining mode. And that means better margins for consumer companies in the days to come. So this is the one theme, which we added the weightage on, consumer space, capital goods. We remain positive, and of course there are many micro opportunities. As I said in my January 2023 webinar, that this year belongs to alpha fund managers. There are a lot of micro opportunities. You need to really get into the bottom of the companies, and there'll be difference between winner and loser. That's how we believe this year is going to pan out. And I think so far so good. We are doing reasonably well, and we do see a number of opportunities across various sectors where there is enough room to make money from both growth perspective as well as valuations perspective.
Good, great. Thanks, Rajesh. The next question again, I think from Mr. Jai Sitaram. With the government spend going up significantly in railway infrastructure, defense in general, it is leading to large orders for many companies. Do you foresee any risks with the B2G businesses in terms of accounts receivable? Are we investing in this theme, both PSU as well as private companies?
Yeah, basically, we need to be, of course, very, very conscious about what we are buying into. You are absolutely right. And as I said, in our portfolio companies, we have a zero exposure to any road company, zero exposure to railways, zero exposure to ports, zero exposure to irrigation, zero exposure to EPC players who are typically large recipient of such large contracts from the government, particularly on the road side and all that stuff. So we are avoiding, many spaces where we see there is no mode, there is no right to win. It is like a commodity war. But at the same time, there are segments which is not a commodity war. Like, for example, defense. Anybody cannot do it. Like road construction, you have thousands players, contractors. Every state is probably 200 players. But when it comes to defense, building missiles, building so many related sectors, there are hardly 1, 2, 3 players. Globally also, there are very selected players. So we need to differentiate between the real business mode. Is there a real good business? Is there a really high quality business? And if it's a high quality business, that those business will continue to enjoy the benefits of oligopoly, monopoly characteristics with a zero problem on receivable. Because the moment you are doing a good business, you command the pricing power. And as you command the pricing power, you also make sure that your ROE, ROC, working capital, everything is under control. So that's how you need to be, of course, very, very careful, very, very judicious about what we are buying into. And that's what the job of the fund manager is all about. So we are conscious of the fact that if we buy any business where government is a customer, we are not saying government is a bad customer, but if your working capital terms are right, then be it public or be it private, is fine. And if your terms are wrong, be it public or private, you are going to horribly go wrong in your investment call. So that's basically judicious decision, what we need to take.
Thanks. The next question from Surya Kothari. What is your view on oil marketing companies like HPCL? Are they attractive enough?
Sorry, Sandeep, I actually missed your question. Sorry.
What is your view on oil marketing companies like HPCL? Are they attractive enough?
It depends upon the, see what happens with the oil marketing companies is basically nothing but the refining margins. And therefore, you need to predict the crude oil price, you need to predict the tariffs, the custom duty, excise, and so on and so forth. So there are a lot of variables in play. And depending upon your time horizon, you decide whether they are attractive or not attractive. Currently, we do not own it. As on now basis, currently we are not owning this.
Okay. Next question. In fact, not getting what exactly Mr. Amit want to ask, given the details about how the macro bond market like USA yield inversion will affect the equity market as a whole.
Well, clearly,
He given the justification as well. Some justification as the crude oil is in range one, it will be at higher territory, then inflation will be again challenging. As the
yeah,
correlation.
got it. Perfect. So basically, the question is on basically US market, and I think I'm not expert on the global
Yeah, today
economics.
Govinji is not there. In fact,
And
he's not
my
well.
colleague Govind is right or not on the Zoom call. But if you read the top 10 global investment managers newsletters, including the BlackRocks and Vanguards and JP Morgans of the world, they all are writing in their investment newsletter, buy India, buy emerging markets. So clearly, the yield inversion is going to make impact on the global equity markets. Interest rates are not going to remain at this high level, but surely they are not going to become 0%. If you look at last 10 years, US 2012 to 2022, the equity market did well because of the zero interest rate. There were companies that were borrowing from the debt market in US at 0%, and they were doing buyback. Clearly, that period is over. That free money period is over. So I think US equity market, I'm not expert. Again, of course, one need to do bottom-up work. There might be a lot of opportunities there as well. It's a fantastic economy, and of course, fantastic innovation is happening over there. But India, the debate of growth is 11 or 14 or 13, correct? The debate in US is -1 or +1. When you have -1 +1 versus 11, 12 debate, am I right? My entire energy, my time, my efforts, all are only for one thing, Indian equity market. And I think we have a number of opportunities. Anyway, I buy the balance sheet, which are low leverage or zero debt. My companies are not going to be impacted if the interest rate goes up. In fact, they gain market share, and of course, the interest rate doesn't remain like that, then it comes down. So those are the cycles. So moral of the story is that, yes, the global market, the growth is going to be under question mark for next 1-2 years kind of thing. The India, the growth story is fairly resilient with a more wheels to the vehicle. So that's my, what I would say, very short, brief answer to Amit.
Okay, great. Thanks. The next question is, looking at this market level, what's your view on doing lump sum or staggering over the next 3 to 6 months? Also, how you are doing for the new investors?
So basically, as I said, we remain, reasonably bullish on equity markets, and we are not waiting to invest. What is in our view for such decision? We need to decide what is the upside versus downside risk. And if you look at the, can market go down by 20%? I think very low probability. Can market go down by 5%? It can happen tomorrow. Volatility will remain high. Can market give us 11, 12, 14% compounding over 3-5 years? I think there is a high probability because economic growth is going to be 11%. With those things in mind, as I say, we are not expensive. The valuations are at 10 years average. ROE of corporate India is improving. EPS growth of corporate India is improving. And you may find me sounding bullish and biased, but let me tell you, friends, that's ground reality. And if you want to check ground reality, you can visit any airport in India. The largest airport probably of the world is Mumbai Terminal, am I right? And it is like a bus station, a typical railway station. It doesn't look like airport anymore. You try to book any hotel in Chennai, Coimbatore, Ahmedabad, Madras on Thursday, forget weekend. And if it is a Courtyard Marriott, I'm not talking about 7-star, I'm talking about a medium 4-star, 3-star kind of thing, you don't get a hotel below 7,900. This used to be 6,000. Friends, the economy is doing well in front of our eyes. It is happening is in front of our eyes. Look at the GST. It used to be 1 lakh crores. Investors used to ask me on the conference call, will 1 lakh crores sustain? Today we are at 1,60,000 crores. Economy is growing at 11%. But the formalized economy, because of the tighter norms, unorganized is losing and organized is improving. Therefore, they are growing at 12, 13, 14%. What we own for your portfolio is top companies in each sector, and they can grow at 14, 15, 16%. And if they grow at 14, 15% in revenue with a zero debt balance sheet, even if you assume 100 bips operating leverage, they have a potential to deliver 15 to 20% compounded profit growth. And when things are happening in front of your eyes, Look at the world. They all are looking at India. Look at China +1. Every company is adopting. And I must tell you that anybody who is skeptical on India story should listen to the recent ABB conference call, ABB India conference call, where he talked about his view on India's capex story over next 3 to 4 to 5 years. So I think we would not like to wait. We are not doing staggered at this point of time, and we are investing lump sum investment. Of course, for your own peace of mind, if you think stagger what works for you, absolutely not a problem. We have a STP plan, liquid plan. You can always stagger over 3, 6, 9, 12 months, depending upon your view on the market.
Thanks, Rajesh. The next question, can you please let us know about the earning growth of AAA portfolios for FY23?
Which portfolio? Because we have it to just a minute. I will let me share screen for you to make it easy.
In fact, you talked about portfolios, means IOP as well as budding list.
No problem. Give me one moment, please. Give me 1 minute, please.
Yeah, sure.
So this is the IOP earnings growth for FY23, 35% compared to Nifty earnings growth of 11.5%. This is for FY23. Let me now take you through the budding beast.
Yeah.
Budding beast portfolio earnings growth is 48% compared to benchmark earnings growth of 11.5%.
Okay. Thanks. The next question is your views on banking and finance as a sector and how you are playing it. As you said, you only invest in the leaders of these sectors.
So basically, one thing which I would like to clarify kind of thing is that this leadership concept it works more into the manufacturing side of it, and it works less into the what I would say the service side of it, because in the service side typically there are no entry barriers like banking and finance. You look at US, there are thousands of institutes, and same in India, correct? However, still we try to do the best within that. So for example, if it is a commercial vehicle financing, we own the #1 company into CV financing. If it is a gold finance, we own #1 company into gold finance. If we talk about consumer durable financing, we own #1 company in consumer durable financing. If we talk about the second-hand transport commercial vehicle, we own #1 NBFC in that space. If we talk about corporate credit, of course, we own the top 5 institutes, all 5 private sector banks of the country, and so on and so forth. So within that also, of course, we try to our best to make sure that we buy the best of the business with the market leadership. But to some extent, the concept get diluted because in the services sector, you don't have much, you don't have only 3 players or 4 players in the street. Like in, manufacturing, I always say we have 40, 50 sectors what we've identified, and they all are basically market leaders. There are only 4 players market, like bearings. There are only 3 players, Timken, SKF, Schaeffler. Or credit trading, there are only 3 players, Crisi, Lycra, Care. Or if you talk about biscuits, there are only 3 players, ITC, Britannia, Parley. If you talk about shock absorbers, there are only 3 players, Gabriel, Munjasho, Endurance. So we select such companies and businesses where there are handful of players, giving them true oligopoly and right to win the market share. And that by nature, it results into the resilient earnings growth and low drawdown and high alpha.
Thanks. In fact, one question which summed the entire webinar, in fact, the market at an all-time high. It seems expensive. Do you feel this is the right time to invest? What do you think?
So market is an all-time high, and it will go next all-time high and then again all-time high, because India GDP is going to grow, and if GDP grows, market grows. So that is not a very important thing. Important thing is whether the valuations are expensive. As I said, like for example, if an IT stock goes down by 40%, that doesn't make IT stock attractive. What is important is whether the earnings growth is also declined by 40%. If earnings growth is down 40%, stock price will also go down 40%. That doesn't make stock cheap. If the earnings growth is down 10%, but stock price is down 40%, then definitely it makes the stock cheap. If you look at the Nifty valuation, if you look at the Sensex valuation from 2014 to 2023, we are trading at 10 years average valuation of 20 times. So markets are not expensive. And as I talked about repeatedly, there are a number of building blocks which are in place, which makes probability of higher earnings growth, probability of super earnings growth cycle to revive, like what happened in 2003 to 2008, kind of it, high probability of happening. So we are therefore not worried on market valuation. We think there are enough opportunities to buy the right businesses and create wealth on the longer term.
Thanks, Rajesh. One bit global question. Globally, US is staring at recession. UK also had the same problem. China facing deflation. How you see the scenario affecting Indian market?
At times, God has been kind, and if China doesn't do that so well, actually it is good news for us, because India is a net importer and we import a lot from China. So if our currency gains strength against Chinese currency, our inflation further reduces.
Okay.
Number one. Number two, if Chinese economy is under a little bit of slowdown, then means they have to do stimulus. And if the China has to do stimulus, to some extent is good for the global world, because global demand growth will not collapse. So I think, too much of macro, we don't try to do too much of macro, because every day, so many data jungle, it keeps changing. But we are I would say, fortunately, we are rightly placed as a country to take benefit of such opportunities.
Great. Thanks, Rajesh. This ends the questions, in fact. Let me check again any questions I missed on the chat box. Mr. Rishi is asking, I have heard that the limit of PMS are expected to increase from 50 lakhs to 1 crore. Sir, I'm just informing you, as of now, there's nothing. It's 50 lakhs only. Just answering on for Rishi sir. It's 50 lakhs. The minimum investment in PMS is 50 lakhs only as of now.
Yes.
Yeah. Thanks. With this, I would like to conclude the call. No more questions. Thanks, Rajesh, and thanks everybody for your valuable time. And if you have any questions, furthermore, even you can write to us anytime. We'll happy to answer to you. Thanks. Thank you. Thanks, Rajesh.
Thank you, everyone. Thank you very much for your valuable time. Looking forward for the next interaction next quarter. Thank you. Thank you, friends. Bye-bye.
Thanks. Thank you. Take care. Happy investing.